All right, dog in the cut here. Not your guru, the exceptional pleb, and October 29th, 2025. Welcome, everybody, whether you're watching it today or tomorrow or 10 years from now. Fed interest rate decision, FOMC, little huddle, October 29th, 2025. And yeah, we're down to 4%, 3.75 to 4% on our Fed funds, our government cheese. And that is significant. It's been priced in for a while now. We got our SOFR curve right here. If we were really cool, we'd have a Fed funds curve, but pretty much does the same thing. It's all government cheese. So it looks like we had one governor, one Federal Reserve Board governor, very fancy title, and they voted for actually a 50 basis point cut. That would bring us down to 3.75%, officially in the three handles. We're getting there. Starting slow, 4% here. And, although we can see bonds as well selling off there. I was very wary of this kind of Fed speak, and that's just kind of like a probably some hedging from long-term bondholders. Nothing so atrocious that it would be kind of still biased long in terms of the long term. It is a long-term bond, so it looks like the market was kind of looking for a little bit more dovishness coming back in the middle of the month, and that slowly kind of eroded up to this point. Not having any data or anything like that, it's getting more difficult to make a justification for cuts when the data that we do have is, it's the Nasdaq going up every single day on the back of getting a new governor. On the backs of a lot of different things. But obviously, that's not the only thing that's happening in this economy. Let's see what's going on here. There's this annoying guy on Bloomberg, so I was just like, might as well just play some music. But we can switch back now. Even though that's some fun little elevator music. All right.
Here in September, and now is really a risk management consideration. And but let's be honest, that goes both ways. There's downside risk to the labor market, but there's potentially upside risk to employment.
In the dot plot last time around, just massive dispersion, a huge difference across the board with different Fed officials and what they expect policy to change and how it's going to change in the year to come. Dan, you mentioned inflation, and I think we've got to talk about this. This is an interest rate cut that comes a week after an inflation report that showed inflation at 3, not at 2, but at 3. How credible is that pursuit of 3%, given that we've missed that 2% target, for so long?
Well, that's what the concern is. The argument, I do think that Jeff is sort of on a little bit firmer footing here. We know that this is a risk management cut. It's not clear that rate cuts alone will actually stimulate employment in this economy right now. I think there's some structural issues that are suppressing employment, which makes it much harder for the Fed to actually have an impact on employment. And lower interest rates tend to accrue to higher income households more than they accrue to lower income households. So, that doesn't help the inequality problem that we already have out there. But I think it's really important to understand that we've got this situation where 40% of that CPI was imputed. Many of it is credible imputations where they get an easy substitute. Some of it's based on changing on a real-time basis more rapidly. We don't know that. The other concern is that we have had more than 4 years where the Fed has not, the proximity to pandemic inflation, had price stability.
Oh, shoot. That was my Bloomberg there. Apologies about that. But yeah, I took out some insurance here, bought some puts, and hopefully can get a little bit of craziness on a pressure type of move here. That's why we're watching the spoos here. But let's see. Nice. All right. Still live here. We will get the Bloomberg live here, people. We will get the financial news.
Communities in which they live, and now 1 in 4 children. You're talking about
Diane Swank, she's definitely not happy with fucking Trump. Definitely not happy. Oh, what? Real time off? Doesn't do me any good. Yeah, Silver does not like that. So if you're in the get bullish stocks rate cuts camp, which I'm kind of in as well, then that's not what you're looking for. You're looking for lower rates, but not because of panic though. You don't want panic. You want kind of just, okay, we're gonna come in and we're gonna cut, and this is what we're doing. So kind of maybe that new Fed governor comes in and is really forceful with that. But at the same time, though, as there was one governor that advocated for the 2 basis point cut, there was also a governor that advocated for no cut at all. And I think that's an effect of lack of data. Just kind of getting annoyed. It is quite nice though. I mean, but also though, I mean, you don't get those predictable types of, okay, I'm gonna log in, I know that there's gonna be some vol here, or vol contraction, or but we have BTC on here. I'm sorry. But I actually like just watching Sol more, but BTC is a more liquid market. But I mean, debatably larger. Yeah, so that EPWMA really useful for I'm kind of letting you know momentum wise of the moving average, just kind of where things are. Obviously green increasing, white to blue, which I think blue is still increasing. Blue still increasing. I just don't want it to go to white. Look at that NASDAQ. Beautiful. Right on that. I mean, and usually that's kind of a slow signal. I mean, just kind of a, I don't mean, probably, you don't really want to wait until that thing turns green, but to get long. But it gives you a good impetus to stay long.
President Smith voting in favour of keeping interest rates unchanged. Something that we haven't talked about a lot in the last 21 minutes that we're going to talk about now is an end to QT. The Federal Reserve deciding to stop shrinking the balance sheet. Matt Lazzetti of Deutsche Bank was looking for that move. Matt Lazzetti joins us now. Matt Lazzetti, what are the consequences of that call today?
Yeah, I think the Fed is simply responding to the increase in funding pressures that they've been seeing in recent weeks. We've seen the Fed funds rate beginning to move up within the corridor. And I think we've always known that the Fed was going to be very cautious in their balance sheet decisions this time around, wanting to avoid what happened in September 2019, where you saw repo rates really spiking. The Fed funds rate moved outside the corridor. And I think they were just going to be always very cautious in handling that this time around. And I think that's why you got the decision today that you did to end QT beginning in December.
Matt, what does this interest rate decision achieve? What does it do? What's the channel through which that rate reduction is going to work?
Look, I think these are all quite small moves. 25 basis point rate cut was already priced in, so it's already kind of reflected in broad financial conditions. But I think it'll help to continue to support, equity valuations that are high, credit spreads that are tighter. It'll filter through into lower front-end interest rates, so help on credit cards and auto loans eventually over time. We'll have to see what happens with mortgage rates, as the chart shows there. Actually, 10-year.
From Bob Michael, where he said of his new palace at J.P. Morgan, AI is everywhere. How is the moment changing? I guess, how is the guess that you have of this moment of AI? How is it changing your view, your overlay of productivity?
Yeah, I think the productivity story is really the critical question for the Fed at the moment. And we heard this from Governor Waller in his comments before the blackout period. And it's really because we have this huge divergence between real GDP growth that is very strong, almost 4% in Q2. Atlanta Fed is tracking almost 4% in Q3, but a labor market that's weakening kind of meaningfully at the margins. And that is being explained by strong productivity gains. My own view is that, yes, some of this is due to AI, but it's mostly reflecting a very tight labor market that we had in previous years, which motivated businesses to undertake CapEx and capital deepening and find efficiency gains. Many of the productivity gains I think that we are going to see are actually further in the future. But this stronger productivity story for the Fed, I think, is one which suggests that rates most likely should stay higher over a longer period of time, and that our star is eventually going to be higher as well.
Michael Feroli will write on this on Friday. You have to think about it in real time as seeing yield. A given company, we're showing 30,000 a door. Another company, we're showing 14,000 a door, and on and on and on. How do you, with all your experience, treat five-figure job reductions at America's finest companies?
Yeah, you accept that it's the economic reality. You accept that we're in the very early stages. You hope that new industries and businesses will be created off of the back of AI that will employ more workers, and there will be a greater efficiency. We saw that when the electronic spreadsheet replaced manual spreadsheets. We saw that in the dot-com era. Hopefully we'll see it with AI.
And Robert Kaplan, the former Dallas Fed president, was just wonderful on this the other day.
What did he say?
He said hope. He said just what Bob Michael said. It's one big academic hope by the haves that there's a good side on the other side of AI.
Luke Cower, I think, has been absolutely brilliant on this. This is regressive up front. Can hold back employment. In the near term, I hope that changes. It can boost energy prices. Electricity in this country is becoming the political topic.
Agreed.
For the next
Strongly
18
agree.
months. Now, the argument you've got to make is that's all going to change. Productivity picks up. Great. Fantastic. But in the here and now, isn't that a bit of a stagflationary story? If you strip out what is happening, say, with energy prices, electricity taking off, If you look at what's happening with labour market, holding back employment, isn't that a bit of a problem for this committee?
I don't think so. I think that they're comfortable looking through inflation, and if there is a problem in
no doubt, they've done that for 5 years.
But if there's a problem in the labor market, that in and of itself will hold back some inflation.
I'm bearish every time my internet like resets. It's like too much data. It's like you're not even close.
We have some semblance of the electric bills of Britain.
I know, Mum, don't worry, I'll take care of it at the end of the month. It goes something like that.
That's how it goes.
Yes, it does.
Okay, that's real, folks.
The energy prices in the UK are absolutely brutal. They're absolutely brutal. And if you face anything like that in the United States, you're talking about the wealth inequality in this country right now. We're lucky to have the energy prices we have because they're so much lower compared to some other individuals, some other nations in the G7. If they face that same situation here in the United States, imagine the midterms 18 months from now. Imagine the local politics and the support for those data centers. What's that going to look like? You tell me.
Governor of Virginia on 14% lift in energy costs.
You're going to want that data center? How many people they're hiring? I know what it's doing to electricity prices. How many people they're hiring? Not many. It's pretty Labour light. Matt Lazzetti at Deutsche Bank. Matt, thank you, sir. Always good to hear from you. Matt Lazzetti there of Deutsche Bank, breaking things down, called correctly the end of QT. That's exactly what we got about 27 minutes ago. But Michael, you're fantastic at this. Going into the news conference, questions for Chairman Powell. What would you like Mike McKee to ask in a moment?
I think he's got to press them on what are they seeing from their own sources of data. What are they seeing from the regional banks and their thousands of economists? They're talking to businesses every day. They didn't make this decision blind, much as it creates a wonderful narrative for the three of us. They reacted to something. What was that?
What do you think the next decision hinges on? What are the metrics? If we don't have the data, let's say the government's still shut down, what's the next decision hinge on?
I think it's going to be anecdotal evidence from businesses. If they're still in a pause, hire, and fire, doing neither, then this Fed will respond by cutting rates 25 basis points.
What is your shop's 12-month call on 10-year yield? We're now, I'm going to say, a 399, 398. John's in charge of that. I just look at the Dow Jones Industrial Average. John looks at all the rest of the data. But on the 10-year yield at a 399, what's your call 12 months out?
Well, let's start with Fed funds. We see that around 3 3/8%. I think you're going to see the 10-year somewhere around 3 3/4%.
Okay.
Bob Michael, JP Morgan, this was fun. It's good to see you.
Always a pleasure.
Again. Thanks for dropping by.
Great.
We've said a few times on this program over the last few meetings that these meetings are going to get harder and harder for this Federal Reserve. At the next meeting, when Chairman Powell convenes things, think about things. Today, the good news, no forecasts. Imagine how difficult it would be to provide forecasts in a moment like this. At the next meeting, can't escape it. This committee will have to put together forecasts for 2026 with the potential of not having any data at all. And even if they have the data, that data could be very, very messy. On top of that, Tom, we might have that shared decision from this administration, which will take away the ability to guide into 2026 anyway.
On this Wednesday, all this talk here as we go to this conversation, the questions and the answers, we have to remember that in, an hour and a half, these mega companies are going to show profit and cash flow that is not in any of our textbooks.
This is why, Tom, so many people right now are so bullish. What matters to the equity market? Not payrolls. I've said a few times, if I told you the payrolls data at the start of this year, at the start of 2025, you would have been hopelessly bearish on this market.
Correct.
What's mattered to equities has been earnings. What's mattered to the man that's about to step into that room is the step down in payrolls. So the market gets the best of both worlds, gets the earnings one and gets the interest rates reduction as well, two. And the man who's about to step into the room is going to deliver potentially another 25 basis point cut at the end of the year. That's the reason why so many people right now have been bullish this equity market. Equities into this news conference at all-time highs on the S&P 500 up by 0.2%. The FOMC divided, voting to cut interest rates by 25 basis points. Here's the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is
transitory.
possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way.
Oh, they didn't like neutral. They didn't like the way that he said that it's neutral at 4%.
Appropriate stance of monetary
Oh
policy
no.
based on the incoming data, the evolving outlook, and the balance of risks.
Did not like
We
that.
face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December.
More neutral.
Further reduction in the policy rate at
Oh
this
no.
meeting is not a foregone conclusion.
Oh shit.
Far from it.
Oh fuck.
Policy is not on a preset course.
Hedging coming in.
At today's
Yeah.
meeting, the committee also decided to
Yeah.
conclude the
That's what I was
reduction
scared
of our
about.
aggregate securities holdings as of
I was
December
scared
1.
about that.
Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as
Market does not like that.
liabilities such as currency keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So
I must be messing up SOFR pretty good.
That needs to be taken on board. We had,
yeah,
say this,
Z 2025,
18 participants on the committee. Everyone
33,
hard at this and
yeah, down 6 bips.
to serve the American people very
doesn't like that.
And at a time
CB doesn't like it. Yeah.
Between our two goals, we have
Russell's not a fan.
views across the committee, and as I mentioned, they were strongly different.
So there is a lot of rate cuts coming in here, and it's kind of coming out right now.
And we're going to be looking at the data.
It'll probably come back as market conditions deteriorate.
I'll just say that.
You and some of your colleagues have
That's
framed
been the trend.
last month and maybe today. I won't.
But it could take months.
Exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation, and then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation. We saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment.
Oh,
And
Radler.
so you put that together.
HV was a good little
S&P and from the public
good little
discussion
tell there.
between the meetings when participants go out
Still
and talk,
took the work
there
of
are
fucking
different
Jay
views,
Powell to
and they
fucking
were
come up
reflected
here,
in strongly differing views in
wrangle
each
things
of them, as
in.
I pointed out in my remarks.
Rational
And that's what leads
exuberance.
me to say that, that we haven't made a decision about December.
So funny
I
to
would
think
say that
about
I think
that.
it's a fact that
Me being like this
maybe some
Bitcoin
different
bull
views, but this is
all the way to
something
this
you
point
need to be
here
shared.
now.
That it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How
But it's
much of
boring
that
to
is
always be bullish,
the fund impressions we've seen in money
especially when
markets
you don't get
related
the
to the
volatility
utility
you're looking for.
issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. Well, what we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be freezing the size of the balance sheet, and the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings.
Sending a signal, more of the same. That right there.
And things like that. So we'll have a picture
That's
of what's
bullish.
going on in the labor market. And the fact that we're not seeing an uptick in claims or
Ridiculous that it is, but it
openness,
is.
suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the beige book again. would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Look at him walk it back. He's not trying to cause volatility.
Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecast for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be. Right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, the housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down.
Get her off the mic. Get her off the mic.
Non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that.
That's not the case at all.
We're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the beige book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our job. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up, in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are